Welcome to episode 1 on how to trade futures for complete beginners. In this series, I plan to go over what is futures, how to trade them, why are they beneficial, why you should learn them, strategies to actually make money trading them. And it's not going to be just one 10-hour video of stacked all videos together. It's going to be a series I'm going to try to do at least weekly until we get from how to start futures, what are they, how we can benefit them, what are prop firms, all the questions that beginner traders have. And honestly, I've been day trading now for 12 years, so it feels kind of refreshing. It's nice to teach beginner traders. And remember, the basics are the most fundamental part of trading. Most traders that have been trading for quite some time are actually still making mistakes because the basics of what they've learned is actually not good. It's like a house. If you have a foundation of a house and the foundation is not built properly, how do you expect the house to last, right? So trading is the very same way. So if you've been trading for a while, I still recommend you watch every single video that I'm gonna be making through this series, because one, you never know what you're gonna learn next, and two, you don't know what you thought you knew, and then you actually didn't know it. So it'd be very, very helpful. So we're gonna start off with, first of all, what is the number one question? What are futures? Just very basic, right? What are futures? And very simple. It's a type of derivative. Let me move this over a little bit. A type of derivative based on assets or commodities. So we have futures for the Nasdaq and S&P 500. That's why I trade. But there are futures for gold, hog, silver, oil, just like about anything you can think of that there's a future form, right? And the asset underlying that future is where we're getting our price from. It's a contract to buy or sell at a date and price. Futures expire quarterly. We'll talk about that a little bit more. So you're pretty much buying a contract that's saying, hey, I'm going to buy X amount of this asset at this date. And then you're hoping by the time that day comes, the price of the asset goes up, so you make money. Now, we don't actually hold the contracts till expiration dates because you do have to buy them. It's not like options. I'll talk about that a little bit more, where if the contract expires, you don't have to buy them. You don't have to worry about it. But with futures, you do have to buy it, so you never want to hold an expiration contract through the expiration date, which again happens once every quarter. So it should never really be, it should never really be an issue. There's also crypto futures, which you might have heard of. They originated before options trading. They were actually created by farmers. They would like to hedge on their crops, so they would build futures. They would expire, or they would cash in before the crop was due. So if they had a bad year on the crop, they were taken care of. It's essentially a form of hedging, and that's where they originated from, which is kind of interesting. It has nothing to do with trading or making money, but if you want a little history about it. When the future expires, as I mentioned, every 3 months, so 4 times a year. Some commodities do have different expiration dates, but you can check all them on cmegroup.com, which honestly, it's never really going to be an issue for you. Now, what is the difference between futures and options? Both of them are contracts. Some people get them mixed up. Futures obligate you to execute the contracts, like I told you, while options don't. They have no Greeks, so there's no impact on any price. There's no theta, there's no delta, there's no gamma, there's no implied volatility, there's not all those other things you have to worry about. All you have to worry about is simple price action. Did it go up $1? Did it go down $1? And you'll move an exact amount every single time. If it goes up $1, you make 20. If it goes down $1, you lose $20. So they're really easy for beginners, especially if you're thinking about starting options. Sticking to futures because you can learn your strategy without any other variables to it. Just simply the strategy, and you can focus on that. Also, which is really nice, they trade 24/6. Sunday to Friday, 6 p.m. EST to 5 p.m. EST. So this is great if you're like, hey, I can't trade at 9:30 a.m. EST. I have work, or I live in Australia. It's like 2 in the morning there. It's fine. You can trade them plenty of time. So they're really, really good. They also never liquidity issues. This is for the Nasdaq and S&P 500. I cannot talk for all futures because I don't trade all kind of futures. And you buy and sell them similar to shares. You buy one contract, you sell one contract. While with options, you're only trading your session, which is 9:30 a.m. to 4 p.m., which means if there's moves overnight, you actually cannot buy or sell it. Some options also on certain stocks can have a lot of liquidity issues, but they do offer different strategies. Now, we're not talking about options today, but just I like to mention it because they are somewhat similar with the contract aspect, so a lot of people do get them confused. Now, what are the futures that you can trade? Move myself over a little bit here. Here are some of the futures you can trade: cryptos, forex, bonds, annuities, IPOs, all kinds of stuff. But I'll be honest, you don't have to worry about them. The way I trade, the way you trade is only focus on two, which is NQ and ES. Maybe YM and gold are also some pretty solid options. Do have all traders that trade gold with this GC that do really well with that. But other than that, I would stay away from anything that you don't understand. Now, futures products. This is really important. What are how much does each future product actually move? So I have them top down for like the most important ones. So of course we have the ES and the Nasdaq. Now you might see right here there is E-mini S&P 500 and micro E-mini and S&P 500. So that's ES, which is the main one, that's S&P 500, and then you have MES. The main difference is the price of MES is 10 times smaller than the price of ES. So if we look at the multiplier, you see that ES moves $50 per point. So if ES is at 5,000, it goes up to 5,001, you make $50. While if you trade the micro version, it's divided by 10. So if it goes up $1, you make $5. And it's really good because it makes, if you have a smaller account, if you're in a smaller platform account, it makes it really good, really simple, really easy. If you don't want to trade ES because you feel it's too volatile, or it's too much sizing for you, to trade less. Now the Nasdaq is $20, that's going to be NQ, and MNQ is $2. Now, a lot of beginner traders make this mistake. Like ES moves 50, which means it's probably the more volatile one. I might want to avoid it. I might want to trade Nasdaq. It's only 20, it's much smaller. You have to understand that Nasdaq moves a lot more than ES. While ES might move 10 points, NQ might have moved 100 points for the same exact move. So you can see the difference. One would have been a $500 move and one would have been a $2,000 move. So just because a Nasdaq is at $20 does not make it quote unquote the safer. It's actually one of the most volatile most of the times, right? Any asset can do any crazy thing at any given time. Most of the time, the Nasdaq is going to be the most volatile one, which can be good if approached correctly. Is why I trade it, because volatility just means more opportunities into the markets. So typically, 90% of the times I'm trading Nasdaq, 10% of the times I'm trading S&P 500, the E-mini ES. Now, of course, there's a bunch of other ones. For example, the Dow Jones moves $5 and the micro moves 50 cents. So you can trade a bunch of different ones. So make sure you're looking before you actually take a trade on an asset you don't understand how much it's moving, because it will depend a lot on your position size. Now, what is a tick size? A point is a $1 move in the asset, while a tick size is a quarter of that. So price moves a tick at a time. So 1 point will have 0.25, 0.25, 0.25. So that tick is simply take the point divided by 4. So $50 divided by 4 is $12.50 a tick. $20 divided by 4 is $5 a tick. So if you're taking profits at half a tick, you on NQ, you just made $10, right? Yeah, I think it's math. $10. Position size are based on the tick size times asset value. For example, yes, trading at $4,000. $4,000 times 50, it's a position size of $200,000. Now, you don't need $200,000 to trade this. Nasdaq, all futures have high leverages, so you can trade them with some brokers as little as a couple $100. Now, just understand, if the price goes against you and you lose $500 and your account is $500, you get auto liquidated. But they do provide a ton of leverage, so you don't actually need $200,000 to buy them. Now let's take an example of risk size. Here we have ES that we're trading with a 5-point stop loss, which will mean 20 ticks at $12.50 a tick. This is giving us a 250 potential risk. While reward, if we're targeting about 24 points, which would equate to 96 ticks, if my math is correct, it's $12.50 per tick. It would equate to a $1,200 reward. So this is how quickly you can do math. You can use points. You could have said, hey, we got 5 points here times 50. Same amount of math. But this is how you would equate risk. And it's really, really simple. Also, on some other assets like options, you would have to account for implied volatility. You're going to have to imply for theta. All those things are really hard to calculate really fast. So you would have, quote unquote, a soft stop loss. You kind of have a range of what you're going to lose, but you never truly know. But with futures, it's always going to be exact. It's always going to be this. There's going to be nothing funny going on. It's always per tick. It's always per point, and all you have to account for is any fees that your broker might have. Now, prop firms. One of the great benefits of futures trading is that it has prop firms. You can use the money for them to start trading your career. And this is really, really good, especially for beginner traders, because you don't want to use your own hard-earned money. But what you can do is jump on a proprietary firm and choose a size of your simulated testing account. A lot of them offer from 25,000 all the way to 250,000. Most popular ones are going to be $50,000 accounts, $100,000 accounts, $150,000 accounts. Now all you have to do is follow the rules and achieve the goals of the valuation, and then you will get funded in a trading account. As you guys know, I've been funded multiple times, got many payouts across my career. So do my students I trade with every single day in my Discord group, which if you do want to join, link will be down below where you can apply and potentially join and trade live with me and learn from me directly. If you do want to learn more on how I trade and how I'm able to beat the markets for the last 7 years, I've been trading full time in the last 12 years of my career. But prop firms are a really, really good benefit. You can buy a $50,000 account, sometimes as small as $69. It's as cheap as $70, $100 for $100,000 accounts. And all you have to do is pass the rules, get funded, and when you're funded, you're trading live simulated funds that if you actually get to the goals, you can get payouts. So for give you an example, I spent $100 or so on a $100,000 account, so I was able to take $30,000+ of total payouts. So do the math, what's a $100 investment to a $30,000 return, right? It's pretty insane. And even if you're profitable like me and you trade a live account, you can still take advantage of prop firms just because they add so much insane ROI to your trading, which is very, very beneficial. You don't need $1,000 to get started. Nowadays with trading with futures, you can start with as little as $100 in your trading career. Now brokers, if you are like, hey, I want to trade on a real account, I want to jump on the live, which at some point it should be everybody's goal, even if you're trading on prop firms and you're doing well. Some of the brokers are like Thinkorswim. They're going to require a lot more margin for you to trade, so it's not really a super popular brokerage, but I do trade them. TraderBay is a really good one. You can connect them. There's AMP, another good one. You connect them to TradingView. Interactive Brokers, TradeStation, E-Trade. Most main brokers will offer futures. Now, the main thing is going to be the leverage, how much leverage you need. Things like TraderBay, things like AMP are usually a lot less than something like Thinkorswim, Interactive Brokers, TradeStation, right? So it's all up to you. Now, let's analyze a futures chain. You have a symbol, which is on your left, and you can see all of this ETS. Now, you may be asking, why does it say H24, M24, U24, Z24, H25? Well, those are going to be how you differentiate which expiration it is. Now, the nice thing about this is they're always going to be the same. So the first quarter is always going to be called H, and 24 is just simply the year. This was the screenshot taken in 2024. M is going to be the second quarter, will always be 24. U is always going to be the third quarter, and Z the last quarter of the year. So you can see when it goes into the next year, it has the H25, which will mean it's the first quarter of 2025. Then on the right, you also have how many days of expiration, the actual expiration, and the last night change price is just simply the price that's currently at and how much it's up or down. So if you see H24, so you know in the right quarter, and you want to trade this in the right quarter. So if you're in February, you're going to trade H24 contracts. If you trade the Z24 contracts, as you can see, it will be no volume. Nobody else is trading them. The volume is going to be really choppy. You're not going to be able to trade them. So you have to understand, if you're trading them live, if you're actually trading on your prop firm account, your live account, you know, make sure you are on the right contract dates. Okay, make sure you have either the H24 if you're in the first quarter, second quarter, M24, and so on and so forth. Now we're in the end of 25, so it should be the Z25s coming up, or we're just changing to them. Right, so now you're also going to have continuous contracts. Those are not going to be typically the ones you trade, but I'll show you. We'll jump over to TradingView real quick. Now let's jump over to TradingView, and TradingView is a software you can use to simply just trade. And I use it to chart. You can execute on different broker. You can see here we have NQ1 exclamation point, sorry. And this right here, NQ1 exclamation point, are the continuous contracts. This never expire. You can be on this one to chart, and you will keep that. It's always going to be the same chart. It automatically will adjust itself for the contract change. But if not, as you can see, if we go down the drop menu, you have all the next expiration. So here you go, and this will be the one you're currently trading on. If you're in a prop firm, it's probably going to show NQZ 2025 because we're in the last quarter of 2025. Now, side note, if you are going to be trading continuous contracts, which typically I do, you're going to have to go down here on the bottom right, I'm going to adjust this and turn on this be adjusted. So whenever the contracts do change, you don't get a huge gap in price and you're going to be really confused. You're going to text Antonio, why is there a massive gap tonight? There was no news, there was nothing, because you didn't have this adjusted for the contract change on the continuous contracts. If you're not on continuous contracts, you don't really have to worry about that. You just have to switch over the contracts that you're trading. Now, what are some of the best platforms to use? My personal favorite, guys, is Alpha Futures. And if you're trading them today, they're running a 30% off sale. That means any account I have are 30% off if you use code BGC. Others are really good. Top Step, MFFU, Apex, Certified. Most of them you can use code BGC, affiliated with some of the best ones, to get the best possible discount at any given time. Now, remember this. It's really important because a lot of beginner traders go into this and they're going to say, hey, I want the cheapest possible option. Remember, cheapest doesn't always mean better. You can go out there and find the cheapest mentor out there, but probably he's getting payouts. He's gonna teach you what you actually have to learn. Same goes with platforms. Just because a platform is cheap, read the rules. Are the rules really hard to pass? Do they cap your payout really hard? Do they have consistency rules? Do they have all these rules? They're gonna make it harder for you to get a payout. That's more likely why they're cheaper. So look at the rules and then worry about the price later. Make sure you're signed up with a platform you actually like. This is why I recommend Alpha Futures. The way I trade, they work really well, and I highly recommend all of them. Again, you can use code BGC at checkout to actually go and get yourself your first account. Of course, learn first and then get yourself a first account. Don't forget paper trading, right? You can go on tradingview.com, as I'm using here, and simply if you scroll down at the bottom right here and click on trading panel, you can move it up and paper trade for completely free. So before you go in and do anything crazy, you can just practice buying and selling on trading. You can see it opens up a buy and sell here, and I can just simply mark it buy one. Let's see, let's buy one. You see right there, terrible fill, down 15 bucks already as prices going down along one contract here. So you can see if I just drag my TP, it will tell me exactly how much I'm gonna make, and if I drag my stop loss, it will tell me exactly how much I'm gonna make, and you can do so easily because again, each point is always going to be $20 on NQ and $50 on ES. I hope you enjoyed the first episode of this bootcamp series on futures, how to trade them, how to make money trading futures. The next one, we're going to be talking about how to actually build a proper trading strategy to make money trading futures, right? All different assets, some strategies work better than others. So I'm going to teach you and coach you exactly on how to do that. Maybe I'll have a special surprise with a live trading there. We'll have to see. As always, I hope you enjoyed this video. Consider subscribing and stay tuned for the whole series. Because at the end of the series, I'll jump on a live account, on a platform account, and pass it and upload those videos so you can see how to actually pass a proper platform account. As always, subscribe, leave a comment down below, and I'll see you guys in the next video.